Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, look, we can talk all we want about where gold is and how it turned around right at 2000. We can also talk about how the stocks continue to sell off, especially on a day like today on Wednesday. Boy, oh boy, we've seen almost constant selling pressure, again on kind of low volume for the underlying metals stocks. But I want to ask you more a broad question first, because it's something that I know a number of resource investors are wondering, and it comes down to just how much worse could it get for these precious metal stocks, whether it's gold or silver stocks. They continue to underperform the metals moves. They continue to trend lower. Jordan, do you have any broad comment or any broad levels that we could potentially expect for how bad it could get for these stocks during, let's say, tax loss selling, maybe even into next year?
I have several thoughts on that. If you're just going by technicals, you can look at look at GDX and GDXJ, and you can look at the 22 lows are pretty close to those. GDXJ, for example, has really significant long-term support around I want to say 27, so that area. So trading at 33.50 right now, so that's a little bit over 15%. So that's one example. Looking at GDX, around the same amount down to the 22 low. So technically, you could say that's potentially how bad it could get for the miners if we're going to move lower and go below the recent low. And as you noted, tax loss selling will be an issue. So generally, that's something I'd say. It doesn't necessarily have to go all the way down to the lows, but you could get 10 or 12, 13% type of decline in those stocks. Now, looking at juniors, you probably have to separate, because I focus on gold and silver. I mean, you have to separate both of those. And I would just say for the juniors, and I usually say that you have to take it on a company by company basis. The problem right now is, we've been in a cyclical bear market for 3 years, and we know that, metals prices are basically at, gold is at the same level as it was 3 years ago. Silver's 20% below or 25% below, whatever you want to use. And costs are up 40% or so, maybe 45%, 50% in some cases. So the margins for a lot of these companies have been eroded. A lot of juniors with development projects and, those who are exploring for deposits and trying to grow the deposits that they have, the potential margins on those projects, given the prices, the metals prices right now and the costs, are the potential economics of these deposits are so much worse than they were 3 years ago. So many of these things are not that viable right now. And so, if you own a junior like that, they could go a lot lower just because they could get hit with more tax loss selling, and because it could take time before gold breaks 2100 and the potential economics really improve. So I think that's, you have to take things on a case by case basis. So for some juniors who need, 2400 to really have an economic project, yeah, things could get a lot worse if gold's not going to break above 2100 for another 3, 4, 5, 6 months. But if for the companies that maybe they're generating cash flow, they have cash, they don't need to raise, or they have a project that the potential margins are very high compared to their peers, those types of companies, when there's market weakness and sell-offs, some money will come into those types of companies and stocks, and so they won't fall as much as everything else. So those would be my thoughts on that. When you're going further down the food chain, like it's hard to give a generic answer.
Well, Jordan, maybe just expanding on it a little bit more, though, when you're looking at your own portfolio or talking to subscribers, would you be avoiding the earlier stage companies then? Because if a development stage company that spent years drilling it isn't getting good valuation because of the cost creep and because of the decreasing margins, why would an explorer that it's building a resource get much more love? Would you be more focused on producers that could capitalize first if we saw that break above 2100 in gold, or would you be looking at royalty companies? How would you be playing it as far as what stage of companies you're looking at in your portfolio?
Yeah, that's a really good point. It's something I have been thinking about. I think the earlier stage companies are going to struggle potentially. Again, provided that it's going to take a little bit of time for gold to break above 2100. I would be wrong. I mean, if we see a breakout in the next month or two, before next year, and then people start to get optimistic, then it could be the bottom for all these types of companies. But provided it's going to take a little more time for that to happen, I do think relatively speaking, you probably have better value in, I think, junior producers, maybe some mid-tier producers. Secondly, the money is going to go into those stocks immediately. I mean, once we see gold break out, I think money will go into the the seniors, the larger producers, the mid caps, and you kind of get money going to the bigger juniors. Then the second leg, you kind of get money going into the smaller junior producers and some of the companies that have top-notch development projects. And then you have to get to 2400 before it really brings buying into those names further down the food chain. But yes, I think just comparing the more earlier stage things to the rest of the sector, I don't think those are great bets right now. I think you're going to find, relatively speaking, I think you'll find better value in other names.
So, Jordan, regarding the developers and touching back on, let's say, 2011, when we saw the majors make a lot of acquisitions and, unfortunately, it seems like get stuck with a lot of these projects that who knows if they'll ever get developed and actually built. The majors haven't bought these projects in this cycle. And now there are a lot of development companies saying, look at how much we've defined. We just need some financing. We maybe need a little bit more engineering, and we can start to go into construction. Do you think some of these development plays that look like they make money on paper through some of the economic studies, do you think these are some projects that might never get built and just keep getting recycled within the sector?
It's very possible. It really depends, the upcoming bull market. I mean, if we have a secular bull market, which I think we will, and you see something that lasts 10, 12, 13 years, and maybe a few of those might actually get built because the real price of gold could become, amazingly high. But yeah, here and now, those projects, many of those, I don't want to say paint everything with a broad brush, but the problem that a lot of those projects have is the capital to build those projects is just dramatically more than it was 2, 3, 4 years ago. And at the same time, even 2 or 3, 4 years ago, the margins of those projects were not that high. And so, the margins are getting clipped. And at the same time, it's going to cost way more to actually build those projects. So you look at those factors today, and there's no way they're going to get financed. They're not producing enough of a margin at these levels. And so I would be wary of those, especially, and also especially the ones that they can't get financed because just that there's, the CapEx blowouts. I would really avoid those types of projects. And if you're looking at developer, and I mean, I own some developers, but I think you have to own the ones that are going to be easier to finance, that aren't going to need to raise, 400, 500 million to build those projects. But those are ones that people have to be really careful with because big development projects with a lot of ounces, I think people can get seduced by those. But there's a reason those stocks are down 70 or 80%. And that's because the economics right now they're just bad. You have to be in a bull market for a lot of these projects to have some viability, and even with that, they're not necessarily going to get built.
Well, Jordan, another discussion people are having is the balance between gold and silver stocks. And you made the point last week when we chatted that you're really less concerned about even the technicals on silver or GDX or GDXJ because you're looking at the breakout in gold to be the prime mover. So from that standpoint, silver really has been kind of stuck in a range. It's not anywhere close to its all-time highs like gold is. Would you be avoiding silver stocks right now in favor of gold stocks?
Well, I mean, everything depends on the price and value. But as far as, market timing and when silver might outperform, I can say this, studying the history of both, gold typically makes a major breakout first, and then silver usually does, whether it can be 2 or 3 months after gold does, or maybe 8 or 9 or 10 months. I have to look at it again. But according to my recollection, that's typically how it plays out. And you tend to get the most spectacular moves in silver always followed the very significant gold breakout. So what that tells us is that, presuming gold at some point in the next, 3, 4, 6, 9, 12 months, whatever you want to say, assuming gold goes above 2,100, it's going to go to 2,450, and eventually much higher. After you have that breakout, that's really the time when I think you're much closer to the strike point as far as when you want to buy silver. Because even, when gold makes these breakouts, yes, silver is probably off its bottom, but it's still, it hasn't broken out yet. It looks relatively cheap compared to gold. So if we're really zeroing in on like when is the perfect time to buy silver and silver stocks, I would say around the time or like right after gold is breaking out. But at the same time, that doesn't mean you necessarily have to completely ignore everything silver. I mean, there might be a couple situations where the value is just so spectacular right now that you have to buy that. You don't want to wait for gold to break out. But ultimately, I mean, if there's one answer, that's really the answer. It's, when gold's breaking out, that's the time when you really want to get interested in silver and silver stocks.
So I've asked you this a couple times, but what does a gold breakout look like? Because we've had gold close at average quarterly highs, sometimes close to monthly closing highs, all these things, but we haven't seen any follow through. So on a chart, very simply put, as simply as you can put it, what would a breakout be for gold that would actually lead to this inflow of capital?
I don't do simple with these answers, but I'll try and keep it quick. On the weekly chart, you have resistance at 2,000 and 2025 to 2030. So quite simply, I'd say look for a weekly close above 2030. Now, another point on that, you have monthly, quarterly, and also some weekly resistance at 2,000. So that will be a level to watch at the end of this month, but more importantly, at the end of December. So again, at the end of December, look for, you get a strong close above 2,000, like you get 2020 or something like that. That would be a monthly and a quarterly breakout. But in the shorter term, weekly close at 2030 is what you really want to watch.
Well, Jordan, just to that point and to Corey's point about when will it actually be the breakout, we have seen price, pop above some of these key levels and even like make historic highs over the last 2 years and 3 years, but they haven't been able to hold on to them. Do you ever look at the monthly charts or weekly charts and want to see a certain amount of candles in a row, like a certain amount of green monthly candles or a certain amount of green weekly candles to confirm that the move is actually entrenched and not just going to reverse the move that it just made?
Yeah, I think the confirmation this time is going to be you have to get real solid closes above resistance. So you still have 2,000 resistance on the monthly, but in July we actually we closed above it, but at 2009. But that's not convincing enough. So I think that's the key word moving forward with these levels. You want to see a convincing close. So you're looking at 2025 to 2030 as the weekly resistance. 2033 or 2037, that's not quite convincing enough. You'd want to see a weekly close that's like at 2046 or 2052, something like that. And the same thing goes for the monthly and quarterly resistance that I talked about. Potentially at the end of the year, you have around it. So the resistance is at 2,000. So hopefully we would get a close that's like 2023 instead of something that's like 2011. 2011 would technically be a breakout, but I mean, you want to see something that's like more than 1% above the level. So again, a convincing close, I think, is what we really need to see.
All right, Jordan, you know what? Let's wrap it up there. There's not much more to say. We can continue to harp on just how bad these stocks are doing, but quite frankly, I guess all eyes just need to be on gold and a convincing close of all-time highs and some follow through. I think simply because, well, gold's failed just so many times to do that. People are going to need a little bit more proof in terms of time. Jordan, thank you, as always, for your time. Link below to your website, The Daily Gold, and we'll also follow up with you in the coming weeks. Thank you very much, Jordan, for your outlooks.